Seconds. Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the MarketSite studio, we have Brian Joyce. He's a Managing Director on Nasdaq's Market Intelligence Desk. We are going to take a look at technical trends within the Nasdaq-100. But Brian, I want to start off with, of course, the CPI data. The market's been waiting for it all week and still trying to wrap my head around the range that we saw being down 3% to now up 2% in the Nasdaq-100. Short covering, is it kind of taking some of the expected news out of the system? I mean, I expected the sell-off in the futures, but to see it ramp back up the way it did this session is quite impressive.
Yeah, I mean, the volatility this year, as you noted earlier when we were talking offline, has just been extreme. We've seen the volatility in FX, in rates, in equity markets. Today's range in the Nasdaq-100 and the S&P 500, biggest in 10 years, excluding March of 20, of course, in the COVID weeks at the extreme lows. But today's move, just a phenomenal move. You know, following CPI, as you noted, the core CPI came in, well above expectations. I think the bigger, it's not so much it was so much above expectations, but it's making new highs. And so we had a brief pullback in the last couple of months. It now spiked higher, is up 6.6 versus expectation 6.5. But the core components of that, OER especially, owner's equivalent rent, that's continuing to hold up, and that's a pretty sticky part of that metric. So that typically lags, I think, 12 to 18 months from housing prices. So we're about 14 months into that. So we could see that number continue to hold higher for 3 months or so.
I mean, this chart, if you take a look at it all the way to the right, it's such an extreme move. It doesn't even really correlate to any other moves. What's up from 1985 you have on there?
Yeah, so let's go back to 1985. So in the early 1980s, only back then can we see where those levels were higher, and that was the Paul Volcker era. You could see in the 70s and 80s, early 80s, CPI was much higher back then. Inflation was much a bigger problem. Hence, we had those dramatic rate hikes. Back then, we're talking about interest rates around 15 to 16%. Right. So we're certainly in a different environment now, but we've come a long way off the lows for sure. In the rates market today, we see the 2-year Treasury yield that broke out to new highs. On an intraday basis today, the 10-year yield, it made new highs today when it made a move over 4.02%. It got to, I believe, 4.08%. And we're looking at the yield curve here. It's now back down to minus 50 basis points. So I'll highlight that right there. And you would really have to go back to 2000 when we can see the curve this inverted. And market is now pricing in. So we already had 3 rate hikes of 75 bips. We're expected to have another one that's a lock for next meeting in November. And we're about 50% probability of having a fifth 75 basis point rate hike in December. So with a little bit more next year, markets are now looking for a terminal rate of about 4.9%, which is what the highest we've seen.
You know, Brian, it's hard to wrap your head around how you're seeing virtually every asset class just with these extreme moves. I mean, think about, is the news out of the system? Has it been discounted? We're going to earnings. We have midterm elections. I feel like until we can get more normalized movement throughout the market, that it's really hard to say that something has peaked or something has bottomed out, because to your point, we haven't seen in over a decade, we haven't seen that kind of move intraday like we saw today with the Nasdaq-100.
Yeah, so with stocks, again, with rates, with FX, even Janet Yellen last night was addressing the illiquidity in the Treasury market. Right. And so if we look at the MOVE index, which is the VIX for Treasury bonds, we could see that's well over the 150 level, and we'd have to go back to, well, this is actually as of yesterday, so I would imagine that this level after today's close will be higher, but we're basically at the highs right now where we were in March of 2020 in the MOVE index. Only higher than that was back during the global financial crisis, when every other financial institution out there was, there was concerns about whether or not they were going to remain solvent. So as you noted, just the volatility is very extreme, and on top of that, we have quantitative tightening, which is really just getting underway at this high levels, since mid-September. So I think already we're seeing Treasury and potentially the Fed in some time in the future will look to address ways to improve the liquidity of the Treasury market.
I'm not a fan of the expression this time it's different, because the spike in volatility that we saw in March 2020 was so short-lived. And I feel like since the beginning of this year, certainly since February, that it is not very short-lived, and it feels as if it's going to be a little bit longer term, even when you think about rate policy having to play out. I mean, it takes a good 9 to 12 months for the market to adjust to these strategies.
Yeah, well, I think at this time it's different compared to what we've seen in the last 30, 35 years.
Right.
Maybe it's not different if we compared it to the last inflation era of the 70s and early 80s. And so that's what definitely is different this time. In March of 2020, that sell-off was very short-lived. If you looked at the month-over-month change in the Nasdaq-100, I think it was down 5% only.
Right.
On an intra-month basis, it was down maybe 30, 35%. But what was different then compared to now is the intervention. We had global central banks, not just the U.S. Federal Reserve, but global central bank intervention, swap lines, programs to buy corporate debt. And so we're not doing that now. The Fed is trying to do the opposite. They're trying to slow down inflation. They're having a problem doing so. It sounds like they've got a pretty late start to address that problem. And so even though we're seeing all of this turbulence, we don't have what typically we're used to seeing is that safety net the Fed put.
Let's pull up your last chart here with the Nasdaq-100 with some fresh technical levels to watch, because it's so interesting. This morning when you and I were talking right after the CPI print, we were saying that it already this week has moved below its June lows.
Right.
And then, so, you think about that kind of headline at 8:30 a.m. and then you look at what are we now, 3:10 after 3 Eastern, and it almost seems like that headline wouldn't have even made any sense with the move we've seen today.
Absolutely. So to me, it's not actually surprising. I was actually surprised to see how sharply we sold off, because even though we're making new highs in that core CPI, it was just a smidge higher than expectations. The headline number is coming down. Now maybe that's driven because of the more volatile food and energy areas of inflation. But coming into this, we know that positioning and sentiment has been extremely bearish for quite some time. And so a near-term rally, should not surprise anybody. Maybe a sell the news, or in this case, buy the news kind of situation. And that's what we've seen so far. So certainly driven in part by covering, and we'll just have to wait and remain, wait to see if there is anything else behind it that maybe we don't all yet know about. Like maybe there is expectations that the Fed or Treasury will come in to implement some measures to improve liquidity in the Treasury market, and maybe other global central banks will do something to improve their situation, such as what we saw a week or two ago in England. But as far as the Nasdaq-100 goes, we did, as you can see, have this big breakdown today below those June lows. We've actually broken the June lows over the last 3 or 4 trading sessions, and with today's early move to the downside, the expectation amongst many people was that, okay, here we are, we're going to really start resuming lower. But as you can see now, we've gained all of that back and then some, and we're basically hovering right around those June lows, which we bounced off in late September. So that right now, what was support potentially at the moment could turn into resistance. So the market has a lot left to prove before we could say we're out of the woods, clearly. So that level is 11,037. If we look at the weekly period chart, this to me it's interesting for sure. So this candlestick right here for this week's pattern is certainly looking like a bottoming candlestick, particularly after being down 6 of the prior 7 weeks. Last week, however, we did have a similar pattern going the other way, and we did have to move lower this week. So you can see for the last 2.5+ weeks, we've been hovering around that June low. Again, it's 11,037. That's the key level I think you need to look at going forward.
All right, Brian, appreciate the insight as always. Thank you for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.